We can get started. Thank you everyone for joining The Current. Today, this is our third edition of Kaiko Research's monthly analyst call. Today, you'll hear us talk all about crypto data, insights, and trends. And you can also subscribe to our newsletter. I just sent the link to our new research website in case you are unfamiliar with our research content today. So on the schedule, we have Desi first presenting crypto trading trends, looking at time zones and day of week. We also have, I'll be presenting a liquidity analysis, specifically looking at ETH using Kaiko's new powerful liquidity data product. Connor will talk about stablecoins, and then Riyadh will talk about liquid staking derivatives and trends in lending and borrowing. But first, before we get going, who are we? Kaiko is a crypto data provider. We were founded in 2014. Today, we offer 4 services. The first is market data. We source data from more than 100 centralized and decentralized exchanges. We also offer BMR compliant rates and indices. This is shaping the entire investable universe of crypto assets. We have quantitative analytics for pricing and assessing risk. And then finally, research. This is all data-driven market analysis, which is read by thousands of industry professionals. So I also wanted to introduce the new home of Kaiko Research. We launched our research website about a month ago. You can check it out at research.kaiko.com. In it, you'll find a full database of all of our reports, our insights, and all previous analyst calls in a single centralized website. Definitely check that out, and I sent the link over the chat. As a reminder, Kaiko Research has 5 products. We have 2 newsletters, one sent on Monday, one sent on Thursday. We have a quarterly report, a weekly chart book, and then The Current, which is the call that you guys are all here today. So before we dive into the trends, let's first dive into the data. How does Kaiko Research do our analysis? So today we collect data from more than 100 centralized and decentralized protocols. And from this tick level and granular trade and order book data, we derive several metrics. For centralized exchanges, which are stuff like market depth, we have spread, we have slippage and trade volume, and same for decentralized exchanges. This is liquidity events like mints and burns. We have pool snapshots, volume, and then LMB data. You can learn more at our website or reach out after the call. So now let's dive right into the content. First, we're going to have Desi, who is going to talk about crypto trends.
Thanks, Clara. Also, we have an echo. Let me try to. So, last time we covered Korean markets. And this time I wanted to take a more global look on trade volumes and look at spot and derivative markets and how they have been impacted by the US regulatory tightening and banking turmoil. So I have a couple of charts. I'll be quick. But the first chart is basically showing market share of volume by country. There are 2 important things to see. One is that the decline in Binance market share has been pretty dramatic. It's the largest drop in market share since 2019. This means that other exchanges have some room to expand. We see that Korean markets and Asian markets have gained market share, but US markets have not benefited that much. And one of the reasons for this is, of course, the very complicated regulatory environment and also the collapse of several crypto-friendly banks. And we can move to the next chart, which essentially shows Bitcoin trading during weekends and weekdays. We know that 2 of the crypto-friendly banks that collapsed in March were operating real-time payment networks, which were pretty important for weekends liquidity. So we looked at Bitcoin trading during weekends and weekdays before and after the collapse of Silvergate. And what we essentially see is that there is a clear decline in weekend trading, and trading during the week actually increases. So people are staying out of the market during the weekends. This is also related to liquidity, which is kind of low, and it also is keeping traders out of the market. So next, we are going to look at derivative markets. We know that the CFTC at the end of March sued Binance and CME, alleging that the exchange is allowing US traders to trade derivatives on their global platform. So we looked at Bitcoin and Ethereum perpetual futures before and after the CFTC. And what we essentially see is a strong decline in trading during US hours, which we saw almost immediately after the lawsuit was launched. It went from 47% to 43%, and at the same time, trading during Asian hours is increasing. This is mostly due to the fact that volumes during US hours are sharply declining, and volumes during Asian hours remain pretty stable. So next and last chart is basically showing that this trend is not at all limited to Binance. When we look at the share of US trading during US hours and trading during Asian hours, trading during US hours has declined on all exchanges from around 49% to around 40% on some exchanges. And trading during Asian hours has increased to up to 30% of the orbit. So to summarize, we have early signs of shift towards Asia, but volumes are currently very low, so it is hard to know if it will be a lasting trend. We know that Hong Kong is allowing retailers to trade, so it could probably boost volumes. So with this, I'm passing on to Clara, who's going to talk about Ethereum liquidity.
Great, thank you. So I'm now going to present a new type of analysis from the Kaiko research team. It's powered by a new data product that Kaiko actually launched a few weeks ago called Asset Metrics. So we're going to look at ETH as a case study and do an in-depth liquidity analysis. And so you've seen a lot of liquidity analyses from us before, but with this new product, what we do now is we aggregate every single ETH trading pair across every single exchange in Kaiko's coverage, whereas before we were sort of taking a selection of exchanges from the most liquid markets. Today, we now have global coverage of every single market. So this lets us give the first example in crypto markets of a fully comprehensive liquidity analysis. So here I have ETH 2% market depth. You've probably seen a version of this chart before. Essentially what it does is chart the total quantity of bids and asks within 2% of the mid price for all ETH markets. When I mean all, I really mean all. This is everything from ETH dollar to ETH tether to ETH BTC to ETH Singapore dollar. So it's a ton of markets. In fact, it's more than 200 across nearly 50 exchanges. And we can see a clear trend here. This is right when the FTX collapses. We see a big reduction in market liquidity from around 400 million to around 200 million, and it's been pretty steady since the start of the year. But what if I want to dive deeper into this data? I want to know what are the ask and bid side of the order books for all of these hundreds of ETH markets looking like. Here I've charted the ask depth and the bid depth within 2% of the mid price. We can see an interesting trend over the past month. First is that bids are now greater than asks. This means that it will probably be a bit harder to push down the price of ETH if you are making a large market order compared with whether you wanted to push up the price of ETH. This is a very useful type of analysis, especially for altcoins that tend to have thinner liquidity. You can actually quantify the amount of market orders that you would need in order to push up or down the price of an asset. So now I'm going to break down this ETH data into its constituent exchange parts, just to show you just how much information we have here. So it's a ton of data. I'm not expecting anyone to fully understand what's going on with all of these exchanges, but you can see that there are now 49 individual exchanges that go into Kaiko's ETH market depth metric. But you can't really gain that much information just by looking at this. So now I want to know, where is the vast majority of this liquidity concentrated? I'll do a market share of ETH market depth chart now. This is the same data, but this time we're looking at it in terms of market share. And we can see that there are only a handful of exchanges that today possess the vast majority of market depth for ETH. You can also notice that the FTX collapse, which is right towards the left, you'll see orange and yellow, that the FTX collapse really reduced a lot of global liquidity. FTX had a significant portion of liquidity that essentially just evaporated from one day to the next. But this is a lot of information, so let's actually break it down even further. Now I'm going to group these exchanges by most liquid compared with other. So here I've aggregated the 5 most liquid exchanges as measured by market depth relative to 42 other exchanges, which I've aggregated here. You can also see in this chart FTX and FTX US and the market share of market depth that they had. And it's a pretty interesting chart because it shows that 70% of global liquidity is provided by just 5 exchanges. And so that suggests that ETH markets are extremely concentrated on just a handful of exchanges, whereas 30% of liquidity is on more than 40 exchanges. This, I think, is a pretty similar trend that you would see for a lot of other assets beyond just ETH. But now I want to understand, what are these 5 exchanges? So now I'm only looking at the 5 most liquid exchanges, and I want to understand the market share. You actually see some pretty expected data here. You have Binance and Bitfinex and Coinbase and Kraken, which today possess the largest market depth. But you see one outlier, and that is Bitforex. So Kaiko Research has actually looked into Bitforex before. They have quite suspicious market activity, some notable examples of wash trading. So if I were a trader, I would probably filter out Bitforex from this analysis, but I left it in here just to understand how having a global understanding of liquidity can help you spot suspicious outliers. But what about the 42 other exchanges? Let's see if there's any notable trends there. So here I've charted only the others exchanges, which again account for just 30% of total liquidity. It's a pretty big chart, a lot of information going on, but you can notice one outlier, and that is at the right side of the chart. You'll notice a yellow exchange. This is Upbit. Upbit is based in South Korea. South Korea recently had a massive surge in trading volume, and it was all concentrated on Upbit. But when I'm looking at the liquidity data, what I find a bit confusing is why market depth increased so rapidly on Upbit and then vanished all at once. This is the same trend as for many other altcoins that I was looking at, and it seems that something was going on Upbit, which caused a temporary 2-month surge in both trade volume and market depth. So if I wanted to research this a bit more, I'd probably look a bit closer at Upbit market activity to see if there's something a bit abnormal going on. So that concludes my ETH analysis, but I want to give just a few more case studies of the power of Kaiko's asset metrics data, which essentially lets you explore any cryptocurrency and the global liquidity for that cryptocurrency. The first example I'm going to do is with TRX. This is the native cryptocurrency of the Tron blockchain. And here I've charted the aggregated ask depth and bid depth for all TRX order books across all exchanges. We can see that before the FTX collapse, there was a huge imbalance between bid depth and ask depth. This means that it was a lot harder to move the price down than it would be to move the price up from the perspective of a price taker. So for example, if I wanted to sell a bunch of TRX, this would be matched with bids on TRX order books. And because there are more bids than asks, it would be harder to push the price down. So an imbalanced order book always is an interesting market trend, but we're not going to dive too much into that today. So let's now look at case study number 2. Meme coins have also seen quite a bit of activity. So I wanted to know, what is the total amount of capital that is deployed on meme coin order books today? So I charted it for Doge, SHIB, Floki, and Pepe for 4 meme coins that have the highest volume, and I aggregated it across all exchanges that we cover. And you can see here that since 2021, there has been about $55 million worth of capital on meme coin order books consistently over time. We have 2 outliers, and it's again the exact same 2 exchanges. It's Bitforex and Upbit. And Upbit in April had a surge of up to more than $400 million in liquidity on meme coin order books, whereas on the 28 other exchanges, it stayed relatively flat. And then the last case study that I want to look at is not looking at a specific asset. Rather, I want to compare exchanges. In this case, Huobi and OKX, which are 2 regional rivals. And I aggregated the total depth of the top 20 assets on these 2 exchanges. And we can see here that OKX, by and large, has larger market depth, which means that it's probably a more liquid exchange at the asset level, whereas Huobi's market depth has seen a slight downwards trend ever since last year. So these case studies all are going to show the power of Kaiko's asset metrics data, and we'll be bringing you a lot more in-depth liquidity analyses from the Kaiko research team. So now I'm going to pass it over to Connor, who's going to talk about stablecoins.
Thanks, Clara. I'll be looking at a recent deep dive I did last week on stablecoins, and in the context of Tether supply hitting all-time highs there today even. And just asking the question, does trust really matter, particularly with these centralized stablecoins? So in the first chart, I'm kind of documenting the ebbs and flows of market cap between stablecoins. If we go to the first chart, so we see obviously in 2021 the kind of wider market was on a bull market, and it lifted all coins, stable coins included. We saw USDC increase by about 10x, BUSD 14x, and USDT by about 4x. But then in 2022 we kind of saw the bear market grow some teeth, and the interesting trend we saw was that thanks to a couple of depegs, USDT market cap fell by about 12 billion, while USDC and BUSD market cap actually rose. But in the same bear market then in 2023, we saw a different trend, and we're seeing a different trend at the moment. And that's a trend of USDT market cap basically skyrocketing. It's up 16 billion now, while all the other market caps bar TUSD fall. So I kind of wanted to dig a bit deeper into that trend and come up with some reasons why. So in the next chart, I take a look at centralized exchange market share. The interesting thing to note here is that USDT, despite USDT's market cap increasing, we have centralized exchange market share not increasing. In fact, it's decreasing. And we can see TUSD and BUSD being the beneficiaries of that over the last couple of years. But it still drives the majority of trade volume on centralized exchanges. And that contrasts to the next slide on decentralized exchanges. So here I have a look again at market share, but this time just on decentralized exchanges. And the interesting thing to note here is that there's a different kind of king stablecoin between centralized exchanges and decentralized exchanges. We have USDC really ruling the roost on decentralized exchanges. We saw at the start of 2021, DAI, USDC, USDT all having kind of equal market share. But that really changed over the last couple of years, as we saw basically DEX users prefer the more transparent, let's just be real, the more transparent stablecoin in USDC. While the centralized exchange users seem to be happier with the more opaque Tether. In the next slide, I kind of sum up the collateral, the most recent attestations of each issuer between USDC and USDT, and we can see that kind of breakdown of assets is a lot different. We can see USDT now have this promise to invest excess profits in Bitcoin, and the defenders are kind of justifying that by saying, well, they're excess profits, but if you look there, there's at least like 50% of Tether reserves in risky assets. So you can make up your own mind about that. But what we're seeing is that the trends between the different users of decentralized and decentralized exchanges, they obviously prioritize different things. We're seeing that decentralized exchange users prioritize, again, the transparency and the more regulated nature of USDC, whereas centralized exchange users seem to be preferring USDT. And in the deep dive last week, I kind of proposed three main reasons as to why they prefer USDT. The first one on the next slide is peg stability. So USDT is one of the only stable coins over the last 6 months that can actually claim it's had a stable peg. We saw USDC traded a heavy discount in March as it got wrapped up in the SVB issues. We then saw DAI by extension traded a discount because of the USDC collateral it relies on. So Tether actually traded at a premium at that time, and it hasn't had a deep peg for 6 months. So it's one of the only stablecoins, as I said, that can say that recently, and we're seeing that's a priority for stablecoin investors, is particularly on centralized exchanges. And so that's the first pull factor for Tether, and first reason as to why I guess the market cap is rising. Second reason I'm given is the liquidity on the next chart. So we have measured here the 1% market depth on centralized exchanges for all pairs that have the stablecoin as the quote asset. And what we're seeing here is that for 1% market depth, USDT dominates by an absolute mile. It has over 100 million USD extra market depth than USDC or BUSD. And with more liquidity comes more volumes, especially on centralized exchanges. And users are definitely going to prefer the stablecoin that has more liquidity, that gives them the option to trade at closer prices, tighter spreads, and you can trade in and out without as much of a loss on a more liquid stablecoin. So that's the second reason why its market cap is increasing. And the third is the versatility or the flexibility you have when you hold USDT. particularly for these centralized exchanges. USDT just absolutely dominates in terms of stablecoin pairs that it denominates. It is over 10x the amount that BUSD has, and over 20x the amount that USDC has. So if you hold, the reality is, if you hold Tether right now, you just have a lot more options of pairs to trade into, tokens to buy. So you just have a lot more flexibility in general. So between peg stability, greater liquidity, and then greater flexibility, these are the reasons we're seeing centralized exchange users in particular favor Tether, and that's been a big reason as to why the market cap has increased so much. So that's all for me. With that, then I'll pass you on to Riyad to talk about DeFi.
Thanks, Connor. This month I wanted to talk about a sort of a fundamental shift that's going on in Ethereum DeFi. Last month we talked about the Shapella upgrade, which gave a whole bunch of new confidence to the sort of liquid staking derivative model. We saw Lido recently open withdrawals, so there's a lot of confidence in that sector right now. So I wanted to sort of break that down. So we can go to the first slide. So we can see here like how much lending and borrowing protocols have changed. May 2021, Ethereum made up about half, more than half on Compound of deposits. Essentially, users were depositing ETH and borrowing stablecoins. Today, staked ETH is the majority of deposits on Aave, whereas Compound has not. Compound V2 has not enabled staked ETH deposits and has suffered because of it. So on the next slide, we can see the borrows. And you can see here that this is also reflected on the borrow side where, on Aave, people are depositing staked ETH, they're withdrawing ETH. Whereas on Compound, it's still sort of the more like, I guess you could say, old-fashioned method where they're depositing ETH and withdrawing a stable coin or borrowing a stable coin. And on Aave, there's a good chance that a lot of these are sort of manually leveraging staked ETH. So deposit staked ETH, borrow ETH, swap that for more staked ETH, deposit it, borrow more, essentially looping that process over a bunch of times to generate sort of manual leverage. But the big caveat here being that assumes that staked ETH will trade one-to-one with ETH for a while. If it doesn't, then they're subject to large liquidations. So the big question here is like, how liquid is staked ETH really? So we can check out the next slide. We can see off-chain that there's no comparison. Ether is significantly more liquid on centralized exchanges. It's at about the 200 million mark at the 1% market depth level right now, whereas staked ETH is under $700,000 worth. So about 300 times less liquid. Now, to be fair to staked ETH, most of its liquidity is held on-chain, as it is sort of a DeFi native token. So we can jump to the next slide and see here that the curve ETH and staked ETH pool. We can see it sort of fluctuated over time, but as of right now, it is the largest curve pool by a good margin. It's about 1.2 billion worth of tokens, and it's nicely balanced as well, which is a good sign. I think the issue here is that this pool is sort of incentivized by the Lido DAO with Lido token rewards. So if I'm a liquidity provider, I provide ETH and staked ETH to this pool. I also get a nice Lido token reward. That sort of makes it, economically rational for me to do this. Now, they have been trying to decrease that reward, but I feel that they're sort of getting to the point where if they decrease the reward too much, they will see an outflow of liquidity from this pool. I think that's sort of been evident from April to May, where in April they were emitting about 450,000 Lido tokens, whereas in May it's 275,000. And this is down significantly from last year when it was like 2.5 million Lido tokens in September. I think they spent close to like $80 million worth total on incentives just for this pool. So clearly they sort of recognize how important this source of liquidity is. but it is a significant expense for that DAO. And sort of my concern here is that the liquidity is so centralized on Curve. There's very little centralized exchange liquidity, and there's a lot of increasing leverage. So to me, that seems like a recipe for like large liquidation events. And I've been seeing sort of concerningly more people that sort of assume that like Lido staked ETH and ETH are essentially the same asset, when in reality they're very different. They have very different liquidity profiles, and I would really just encourage like protocols and users to be sort of mindful about leverage that they're taking with liquid staking derivatives, because they are not as liquid as Ether itself. Cool.
Great, so now we'll do a Q&A session. Feel free to ask in the little questions panel. So it seems like we have one right now. What was the cause of the increase and decrease in up-bit trading volume? Was it a fee reduction? That's a really good question. We're actually going to look into this to better understand why it was such a rapid increase and then just decrease in trade volume and market depth. So hopefully you'll see that analysis coming up. I don't have a full answer right now.
A lot of it could have been altcoin trading as well. We saw kind of obviously with we saw the kind of altcoin season return for a bit, for a brief stint of a couple of weeks or a month, I guess. And I know Korean exchanges, and Upbit in particular, have shown like a propensity to trade in altcoins. I think a chart we had before showed about 90% of the volumes on Korean exchanges were altcoins. I could be wrong there, but yeah, that could have been a big driver of volume towards Upbit as well.
But I think though that looking at the data, it seems almost like a frenzy that came and went. So I'm always careful to understand when it's a trend or when there's something that seems to be abnormal going on. So hopefully we'll find out soon. Okay, we have another question. Does Kaiko allow users to set arbitrary thresholds for market depth instead of just 2%? So yes, we collect 10% order book snapshots. So essentially we have any range within the 10% range. Kaiko's asset metrics data product actually lets you go up to 0.01% all the way to 10%. Okay, well, if we don't, okay, we have another question. What type of Kaiko data do you use to see the abnormal trading activity? So we're mostly looking for outliers in this case, trading activity or order book activity that doesn't match the existing trend. And for example, if there were a trading fee reduction, then that would easily explain why volumes had increased on one exchange versus the other. But if there's no apparent catalyst or readily, I guess, obvious change in something going on an exchange, then we can assume that there might be something abnormal going on. It's very hard to be definitive though, and to know with 100% certainty what is abnormal versus what is just a real market trend.
Yeah, just on that, yeah, I've done a deep dive before into the Bit4X. I think Clara mentioned that Bit4X we had done some research on before. And I used tick trade data there, so Kaiko tick trade data. So we can see trade by trade. They're classified as buys or sells. And I saw a couple of things that were making me think, yeah, like market depth was really high on Bit4X. That sounds a bit unusual. They were leading or claiming to lead volumes for Litecoin and Filecoin. So I looked into tick trades on that and could see that buys and sells were happening for the exact same amount at the exact same second. So that was one use of the data. We could see that maybe was a bit on the abnormal side, where yeah, buys and sells were happening within the same second. So yeah, that's just to flesh out that.
Great. Well, thank you everyone for joining today. I just sent the June edition of our monthly analyst call, which you can already register to today. And also be sure to check out our research over the next month. We have some great reports coming up, and see you next time.
Thanks, everyone.
Thank you.